going to change gears completely now. And we're going to talk about married puts. I'm not sure which one I want to start with, so I'm going to be fair and go in order as they came in. Fernando starts us off. The married put following the radioactive trading techniques as listed in the blueprint. And we're going to be launching the special end-of-year bonus offers for the blueprint very soon in the next couple of days. So we're not discounting the price of the blueprint, but you're going to be able to receive many special bonuses whose actually combined bonus price is equal to or above the cost of the blueprint. But in any case, Fernando says, on married put structure on quality stock, very often I add a call, at 0.2 delta, 8 months minimum. This helped me. I sell call on front months having a leg open towards the climb, which is best conditions to add the long call far in time. Okay. Delta 8 months minimum. Okay. Okay, so the best, it's a catch-22 in a sense, Fernando. Okay, so what Fernando's saying is normally what I would do, in general, when we open a new married put position, we post it for the Fusion subscribers at Radioactive Trading. We're going to buy a stock and buy a put option that's at least 150 days out in time, maybe a little bit more. And we're going to control our risk to single-digit percentages. I want a stock that's moving. I want a stock that has some volatility, but I also want to control my risk to a reasonable level. Good pricing to me looks like this RBA position. Ritchie Brothers don't even know what it is. It's auctioneers. So I'm going to buy stock at 70.68. June 75 put, 6 months out in time for about 9.50. This means instead of the covered call where I've capped the upside profit, I'm flipping it and I'm protecting the downside first and worrying about income to pay for that insurance later. I'm not going to sell a call right away. I'm going to wait for the stock to move up to get a better premium and a better strike on this position. Now, Fernando's adding a kink into it. Why? Because if I did sell a call right now, let's go out to January. And I always want to sell a call at or above the put strike price. Otherwise, I'm creating a bearish position on a stock I'm bullish on. You sell a call below the put strike price in the structure, you're entering into a bearish position on a stock you just researched that you were bullish on. That's trading against yourself. You don't want to do that. So let me go ahead and sell the 75 call. Not too bad. Lowers the risk to 5.1 and has a 3% return. But as you can sort of see here, we have a peaked return at this point. That's the 3%. That's the max return at January expiration. But it starts to tail off after this. Why? Because at January expiration, the call goes to a delta of 1 if the stock is anywhere above the price. I'm losing 1-to-1 on the call that I'm gaining with the stock. When I opened the married put, we had a positive delta, but the put was only probably at a delta of 0.5, 0.55, maybe 0.6. So for every dollar stock moved up, I'm losing on the put, but I'm still gaining positive delta and having a profit. Now I've canceled that because at January expiration, this delta does what? It goes to 1 if it's in the money or 0 if it's out of the money. So I'm not gaining any more positive delta, but meanwhile, as the stock goes up, my far out put is still declining. So that's why it pulls off after that call starts going in the money. And to help with that, what Sam says he's doing is he's buying a far out in time. Did I say Sam? I meant Fernando. I'm sorry, folks, if I said Sam. What he's doing is going equal out in time. I can only go 189 days here, Fernando. I know you said 8 months minimum, but he's buying an out of the money call with a low delta. It'd probably be the 90 or the 95. I'm going to use the 95 strike. Okay. And let's go ahead and buy that one as well. All right. Now this looks skewed, but what we did is we still took in about 118 for this January short call. And then we paid 80 cents or so, 88 cents or so for the June 95 call. That may be at that 0.2 delta. We'll take a look at that in a minute. It doesn't really matter. So what does that do? If the stock keeps going up, sure, Sam still might be obligated to deliver shares of stock, might have to cover this obligation, buy to close it if the stock really starts to ramp up, but he's gaining some value on this extra far out of time long call, which leaves the upside open as well. What would be the best conditions, Fernando was asking, to buy this call? I think it's the same situation as you would in any call, which is ironic in a sense. Because if I was in the situation where conditions where I'd want to be buying far out in time, out of the money calls, I wouldn't be selling a call against the stock that I own. So I did that backwards. I wouldn't be selling a call because that means I'm extremely bullish on the position. That's what I meant kind of a catch-22. When is the best time to sell a call? It's usually after you've had some market movement and the volatility is up, but you're entering into sort of a channeling position. Remember, when I sell this 75 call, it's because I don't think the stock by January would be trading above 75. I think it's going to be trading right around that price. It's the only reason why I would sell it right now. But that's not the time to buy that call, is it? Because the volatility is high. Now, hopefully far out in time, Fernando, the volatility would be lower in that situation. You never can tell. Remember last year, coming into August and September during our discussions, we were looking at calendar spreads. And around September, we couldn't find any calendar spread where we were selling the October, the November, or the December series. I'm sorry, it was October. Yeah, it was September and October. We couldn't find a series where the implied volatility ratio was in our favor, where the implied volatility of the September or October options we were selling were lower than the implied volatility of the options we were buying in the calendar in January, February, and March. Why? Because January, February, and March options were going to be affected by the election in November, and the September and October options weren't. And we weren't into earnings season yet either. So it was opposite of what we wanted. That wasn't the time to be buying calls, even if they were out of the money of the 0.2 delta, because the volatility was high. Now things have settled. Now is a good time to potentially buy those, but if there's still volatility there, you might want to wait. Where I was going with what it is, it kind of sounds like you're in the good conditions where you'd want to go, meaning that when you open the Married Put position, it's because you found a stock that you feel is stable to bullish, has been showing maybe a good stock price trend, which means the volatility is hopefully relatively low. That sounds like a good time to buy it. Bullish speculation, volatility relatively low, and showing the trend that you want. I'll throw this in for Sam right now since we're on this. He said he's been having great success recently. Let me find his comment. There it is. Improved my trade setups. He's following a 5 EMA, 8 EMA, 13 AMA. Look for a squeeze when you see the EMA creating a fan action. Triggers a bullish or bearish buy or sell signal. So along those lines, and I don't even know that exactly what he's referring to there. I know somewhat of it. I just can't see it in my head right now without looking at it. But in any case, that would be a signal to potentially buy, even buying further out in time. And then when you see the position start to stabilize, it hits the top and starts to stabilize, that would be the time to sell the call. Because remember, when you're selling the call, you don't, even though it's shorter term, you're picking a price where you don't want the stock to go above that. Okay? So a rough little insight there of the way that it looks, not too expensive, but it's probably going to take away half or a little bit more of your first right against that position in that case. So it'd be pretty, no, it's a good approach, but I just, in general, that's what I would think to look for as far as when to buy the call. Then the other structure, Fernando, is something that I always say to investors, and I think you and I have had these conversations before during some of our coaching sessions. If this is the approach that you want to do, whether you're selling a call now or not, don't try to outthink yourself. If your approach is to set up this structure to sort of double dip far out in time with a low delta call to increase returns if the stock goes up as you want, don't try to outthink yourself. Do that structure first. Okay, pay for the call right now if it's in the situation that matches what you expect for the bullish position. That's why I'd be getting into the Married Put to begin with. Then worry about selling the call later. A lot of times if you try to over-analyze it, you try to say, oh, what's the best time to do this little extra wing thing I'm trying to do out here to the outset to leave my upside open. If I do choose to sell a call, you'll probably never do it because you're thinking to yourself, it's not the right time. Oh, I'd like to see it a better time. Then that better time never comes. You can really overanalyze yourself out of the structure. So focus what's most important to you first. Naturally, we all know the most important thing is the stock plus put combination to give you the risk that you want. Now what's most important to you next? Is it the call premium to help pay for the risk and the put? Or is it this extra double dip because your success rate on picking stocks that move up 5, 10, 12% in the first 3 months has been really high? which is the best boon to your portfolio. And then try not to overthink, is it the right time? Is it not the right time? Just go in. All right, so Edison, perfect question. You're staying with the married puts, but we're going more into the search discussion as opposed to this extra structure we just covered with Fernando. Edison wants to know, is there a way to search for a $30 to $35 stock that is a good married put candidate, preferably with weekly options? Okay. Well, the easiest thing to do, Edison, of course, is go into fundamentals and just change it 30 to 35. Change the stock price range. The default is 9 to 200. I prefer to use this default because it has the exact structure I want that we teach for the married put. It has the other stock criteria I look for in the list. No guarantee it's going to have weekly options, but I'm going to do this first. Okay. So are there any out there? Let's submit the search. None. That's okay. Let's not worry about that. What that means is that there's no real good candidates that match our default married put structure in the stock lists we're using in the $30 to $35 range. No problem. Let's open our criteria. I'm going to go in the lists. Okay. We're going to go to no lists. We're going to open up the market. I'm going to do you one better, Edison. I'm going to change the default list that we do prefer to use. And where is it? I know it's here. In our default list, I'm looking for stocks offering weekly options. But what did I do? See, we use those lists in the search, Edison, because it's performed well. We've done different, I'll have another one coming up soon at the end of the year. We always do that. But we have different reviews of how did the positions that matched our criteria, stock performance alone over a 3 or 4 month period, perform against stocks that would have come up in the married put search against S&P 5-star stocks, NASDAQ 100, so on and so forth. And we test over 3, 4, 6, and 12-month period. And 90% of the time, the list we use, the stock performance over that 2, 3, 4, 6, or 12-month period outperforms the S&P 5-star list. It outperforms the NASDAQ 100. Now, I said 90%. There's always windows. You think about April to, what was it, July? April to August. The NASDAQ 100 stocks outperformed the list we use and the S&P 500. But that's 1 4-month window. And I'm talking about doing this. We do this comparison to make sure that we don't need to tweak our list. We do that just about every year for the last 3 years to make sure it's still outperforming, and it is. But that's okay. Remember, the married put concept, we have our approach that works well for us, but the married put is to be used on any stock that you feel is bullish, and it appears, Edison, that you want a lower price stock and you're going to try to force selling weekly premium against it if it's available. Nothing wrong with that. But now that I've taken out the list that we were using before, which had to match certain stock criteria to be in there, what I probably want to do now, Edison, is enter in more stock criteria to filter out stocks. I'm already using the earnings per share growth. That's fantastic. Positive earnings. I might look for a PE ratio of, let's say, 0 to 70 or 0 to 50. I talked earlier about market cap. Maybe I just want to see mid to large cap stocks. So this is measured in millions. So I want to maybe look for stocks with a market cap greater than 2,000 or maybe greater than 2,500. Let's just put that in as well. We are looking for stocks in an uptrend above the 50-day moving average. I might change that to the 20-day moving average. And then I might increase my volume. This is measured in thousands. So it's looking for stocks that have an average volume over the last 90 days of 300,000 shares. Let's just up that to 750. And I could put in 1,000 if I wanted 1 million shares on average per day. I could use MACD if I wanted to, or number of days the stock's been above the 20-day, 50-day, or number of days the 20-day has been above the 50 and so forth. But let's just leave it as is for now and see what we get. So we open the entire universe of options. Then we narrowed it again to just stocks that offer weekly options, told it to be in the $30 to $35 range, added in some criteria, and there's your one. SYNF, 3227, 35 put for an 8.1% risk, and option chain. Okay, so it has all the weekly options. Oh, this is the put chain, I'm sorry. So you could go to the call chain. Not bad premium, not great, 1%, 0.9%. That's what we'd expect in that case. So Edison, that's how you do it. Change the criteria to your needs. For what you're looking for, you probably want to change the list. Can I open this up more? Sure. How would I open it up more? Take out some of the fundamentals. Not a great suggestion, but let's say I take out the PE ratio and leave the earnings per share growth, and I take out the market cap, which is probably a good idea looking for $30 to $35 stocks. Same one. I don't want to do this, but I'm going to take out the positive earnings per share growth for performance of the stock. There you go. Kraft Heinz, that's one that I'm in right now. Bulletproof position, 10% return, about 11% liquidation. Have another 2 cycles to sell calls against it to increase the premium. Should have popped into my head as soon as you said it. Not bad, plus the dividend. MGM Resorts. Interesting. I don't know how that stock's been performing. Here's a ETF. Pretty decent. Price-wise, I'm not saying that this is a good pick, but it's there, United States Oiled, and then, of course, that financial that came up again. So that's how you would do it, Edison. That's how you'd open up. Change the list to look for stocks with just weekly options. Change your stock price. Add in other criteria. If you only have 1 or 2 results, maybe open some of that fundamental or technical criteria, but then do more diligent research into the performance of the position. All right, was this Kipp? It was, okay. So Kipp says, let's see. Oh, before Kipp, there we go. Yeah, Sam says, when selling the calls, look for the resistant level. Yeah, back to Fernando. Sam says, when the market is looking for a top, that's a good time to sell calls. Exactly. When I start to see the tops being hit and the market sentiment tool going into sells because we've been hitting at the top there, that's when I look to sell the calls as well. Okay. And yeah, Fernando says, I always sell the call based on the blueprint. If assigned, I sell the put. Yeah, it's income method number 7. Okay. Oh, pen. Okay, there's that pen position again. Good, good. Okay. Now to Kipp, staying on the married puts. Kipp says, regarding within the married put portfolio, that might be 50% of a portfolio, for instance, can you talk a little bit more about position sizing in each married put position? Absolutely. And I think to do that, I'm actually going to go to radioactivetrading.com for a second, because there's a feature on the search for new RPMs on the married put. You don't have a lot of flexibility on radioactive trading for the search. But what you do have is the availability to look for the controlled risk. So let's go to the RPM report. This shows me the married puts, same married puts we should see that just match the search and power options, unless one of the sorts has changed. I think we were on a webinar 3 weeks ago, and I went to the radioactive site, and we opened the RPM report, and I noticed that the order was different because the sort was altered. Instead of sorting from highest earnings per share growth, it was sorting by the risk. Okay, and this one looks to be very similar. Okay, it's just fewer results in that case. Why? Might be because of this filter I'm using. So, as we've talked about, the proper married put structure, we're going to have controlled risks between maybe 5 to 8%. My preferred level that I change, by the way, Edison, on the search is the default risk is shown to be between 3.5 to 9%. My personal preference, and I have no statistics if this performs better or not, but it's just for my personal preference, I usually change that so my max percentage risk is between 3 to 7, and if we're in a highly volatile structure like we were back in April and back in May, I might go 3 to 8%. But usually I don't go higher than 7.5% if possible. That being said, that's the first layer of protection. What does it mean? Well, I'm buying a stock. Okay, let's take, we'll stay with Ritchie Brothers. We already looked at it. Buying a stock at 70.68, June 75 put. If I get the ask price, if I pay the full price, it's 9.80. So my total cost basis goes to 80.48. But I own the 75 put, meaning that I can at least, worst case scenario, get $75 back for this position, even if the stock falls to $2 per share. So my maximum risk is 5.48, or 6.8% of what I had invested, the 80.48. Now, 50% of my portfolio, Kipp, let's say that represents $50,000. Okay, let's say I have a $100,000 account. I'm allocating 50 cents to married puts. I'd probably still use the 1% because that's the total portfolio value. I'm sorry, I'd use the 100,000 because that's still the total portfolio. But let's just say $50,000 portfolio, and I want to allocate up to 2% of my total portfolio. I'm sorry, I said that wrong. I only want to risk up to 2% of my total portfolio value in any position, which means what? It means that monetary risk of $548 should not be more than 2% of my total portfolio value. So let's change that. Let's change my rules here. You can see I can do that up at the top. I'm going to change my total portfolio value, Kipp, to 50,000. And I'm going to change my return to 2%. Okay, so 2% of that $50,000, of course, or 2%, sorry, would be $1,000. So this is 548, so I could only trade one contract. I'd only do 100 shares in one contract. This one here, the Comcast, is a risk of 393, so I do 200 shares and two contracts. I shouldn't do 200 shares of this because actually it only put me at 2.2 in that case. So I probably would do 200 shares and two puts, honestly, Kipp, in this situation, $50,000 and risking 2% of my portfolio, because that's at worst case scenario. If I get the midpoint, this is only going to be 1%, and I could do 200 shares and two puts. So the idea is that you're controlling risk on your investment to that 5 to 8%, let's say, against the position. But the monetary risk of the married put should only represent 1 to 2% of your total portfolio value. So if you do take the full loss, you still have 98% of what you started out with to invest of the portfolio. Yeah, you lost 5% on the position, but you only took your portfolio down by 2% monetarily. That's the idea. That's that second layer of protection that's talked about in the blueprint. In addition to controlling risk with the proper structure, now what we're going to do is we are going to make sure that the monetary risk is no more than 1 or 2%. I've grown, not grown, but I've upped it over the years. So it's up to the individual investor. If I want to be less than 1%, I want to be 1%. The monetary risk of the position dictates how many shares and contracts to buy, Kipp. But what I prefer to do is I moved up a couple of years ago from 1 to 1.5, and then I moved up to 2%. And a part of the reason why I moved up to 2% was because of 2018, because of the increases in volatility after that February 2018 event I keep mentioning, then that disastrous October, followed by that disastrous December. The volatilities were so high that the risks were going, as I mentioned, where I would normally find a position that had a risk of 4 or 5%, it was now 7 or 8%. So I had to up it to 2% to find a little bit more positions that match my criteria. That being said, by the way, let's go back. Sometimes it's okay to overpay. Sometimes it's not, but sometimes it's okay to overpay. Let's go back here. Open trades, trade tracker, the current open positions that we have, and the Kraft Heinz position. I just want to pull that up. April 8th. So after that March decline, the February to March decline, March 20th, I think 25th was the bottom, really. And Ernie, that's when Ernie was starting to look at buying calls on things he knew would recover. Apple. So he's buying January calls in April for Apple. Not Comcast. What was it? Apple, Hewlett Packard, Lowe's. It was another, Citibank, I think. I can't remember exactly. And so it was in April that I bought this married put. The initial structure was buying Kraft at 27.36 and buying the January 30 put. In normal years, prior to all the hecticness in 2008 and what we saw in 2020, and still seeing in 2020, this normally would have been a reverse risk, meaning what? Meaning normally if I open a Married Put on Kraft, this is the third time I've traded it in the Fusion portfolio, and it's done well each time. It's not consistently. It's one of those, Fernando, when is the right time? Well, when I see KHC being depressed and near a bottom over the last 8 or 6 months, I know it's going to come back and it pays a dividend. So I usually buy in at that time, and it's a good time to go through it. 9%, 10% returns. The other one was a 12% return on Kraft last time I traded it. In any case, in a normal market condition, we go back to 2016, 2015, 2017, buying the stock in an 8 to 12 month out put option against it that's one strike in the money would be a 4.8% risk, not an 8.4% risk. I overpaid it because I was extraordinarily bullish on the position. Okay, so it's okay to do that from time to time, because what does volatility do? It also gives you some great short-term premium that normally wouldn't be there. That doesn't look that great, but I think this is only a 4 or 5 day trade, a 10-day trade, excuse me, from, no, it wasn't, I apologize, 6.2 to, yeah, 7.2, okay. So it was a 1 month trade, but it did lower the risk by 1.2%, and a 1.2% time value is pretty decent for craft with an out-of-the-money call. Oh, so Fernando does add in relation to that, Kipp. Kipp does say, that makes total sense. I thought I understood that from the blueprint. Just want to clarify. Excellent, Kipp. Going back to that, Fernando says, it is a business of risk management. Controlling the risk has changed my investor life. Thanks a lot, you guys. You're welcome, Fernando. I'm glad we've been able to have all these discussions regarding the married puts and the different ways. And I always am encouraged and intrigued by the different ways you look to try to approach it in that case as well. So that's fantastic. Again, this real soon. It's going to come out real soon. It's going to be active Monday at 12 noon. But our special end of year promotion for the blueprint, the full course on the radioactive trading technique, is going to be released on Monday. Y'all are going to see our email from me about that. Of course, we're going to have some more blueprint owners, members only webinars as well in the next couple of weeks, in addition to a lot of webinars about the married puts and the special end of year offer for the blueprint as well. Okay, so we covered that topic. There is a there's probably going to be a members only webinar also I'm going to post this weekend. I'll show it real quick. Bill had emailed me about a Hologic position that he's in, and it was in the money yesterday. So his position here on Hologics was the 75 strike, and the stock was at 76.32, and he wants to hold it long term. So he's looking for the rollout opportunities. Might be different now, unfortunately, but when he went to the position analysis screen, he's got the January 75 call. I was thinking, maybe should I roll up to the 80? Should I roll to February? Okay, good. When he looked at the rollout opportunities, now it does, but it only showed him the March series, and he wanted to know why. And originally, one of the reasons why, because the buyback cost for that call was at 410. So even rolling to the January 80 would have added to the risk and not really helped the profit too much, because the buyback cost was too high. Now it's better. Now it's in there because the stock pulled back. But he was only seeing the March rollout opportunities, which is equal to his put strike price. Why wasn't he seeing February's? Well, that's a trick of this stock. The February series is not available. It won't be available until after December expiration. So I did a video real quick for him. I had a full day of coaching sessions today, so I couldn't squeeze Bill in and try to get him into that. But I worked late last night and got it done between a couple sessions today to finally convert the video. But we did a video showing Bill how he could simply do it manually using our tools here to manually evaluate buying back the 75 and selling the 80. Thankfully, that's there now in the rollout opportunities, so he doesn't have to manually do it. We simulate buying the call first and then selling the next one as well. Well, where I'm going with all this is we talked about other management ideas. What if I buy to close the call now? Use income method number 4 now that the put was in the money in that case, and then sell the call, and how would that look? So we posted that video to YouTube, but it's likely only going to be available for Blueprint members only and Fusion members only, because it's specific to the income methods of the radioactive trading techniques that's discussed in the Blueprint, of course, as well. All right.